Today, I want to talk a little bit about the risk inherent in today's stock market and a few options that investors can use to navigate it. In my opinion, the stock market is priced right now for perfection, and that's not necessarily a good thing. What I mean by that is what gives a stock its intrinsic value, the real value of a stock, is essentially the present value of its future estimated earnings. Yesterday's earnings don't matter. Future earnings matter. And right now, prices are so high that earnings need to continue growing uninterrupted for these prices to be accurate. And when stock prices are depending on optimistic earnings growth for years to come, without healthy skepticism and room for error, that's when volatility can rear its ugly head. Here's how I'm framing the next 12 months, and this is just my opinion, but a 20% or more upside would be borderline euphoric, bordering on bubble territory. Anything between 1 and 15% gain in the markets, I think, would be healthy growth. But a 20% or greater decline, which is defined as a bear market, it's becoming more likely for a few reasons. First, we're still seeing after effects from the Fed's aggressive rate hikes. Second, there's a lot of speculation going on in the private markets, and it's been consistent and increasingly high. Thirdly, we're coming into the second year of a US president's term, and that has historically tended to be the lowest performing of all 4 years on average when it comes to US president terms. And finally, valuations are just so stretched. The risk reward balance is off. It's just not very attractive. So let me illustrate this with some simple math. Imagine someone comes to you and has you spin a wheel, and you have three options that wheel might land on. One is a 50% chance of earning 15%. The other is a 25% chance of breaking even, 0, and a 25% chance of losing 20%. Well, the expected return would be only about 2.5%. Now, I'm not saying that that's the expected return of the stock market, but I'm going somewhere with this. Think about that, 2.5% on those odds. Expected returns on CDs are better than that right now. So you have to think about this in terms of risk versus reward. If the reward isn't high enough to justify the risk, it may be time to change strategy. A 2.5% expected return, for example, just doesn't justify full market risk, especially for intermediate term investors, those with 15 years or less in time horizon, and certainly not for short-term investors, which would be 3 years or less. But here's the tricky thing, the markets can defy gravity for years, and late-stage bull markets often deliver some of the biggest returns right before the turnaround. So if an investor goes too conservative too soon, they might miss those last compounding years, which can make a huge difference, a life-changing difference, when you think about this compounded over time. So if we can't predict when the next downturn will hit, the better question is actually, how do you structure a portfolio that can endure either outcome? Can you do that? So to answer that, let's look at some fascinating research from, I'm going to butcher his name, I'm sure, Pim van Vliet, PhD. He's chief quant strategist at Robeco. In a study covering 1900 to 2025, Van Vliet points out that no asset is truly safe in the truest sense of the word. Every one of them has suffered painful inflation-adjusted losses at some point. So if you think about it, cash, of course, loses purchasing power quietly through inflation. Bonds go through bond winters when rates rise. Gold swings wildly from euphoria to despair. Gold can be very volatile in the short term. And stocks, while they're long-term winners, they can also drop 20 to even 50% in a single bear market or more. The goal isn't finding something safe. It's finding what loses less and still compounds over time. So Van Vliet compared 4 portfolio types. The permanent portfolio, this is 25% each in stocks, bonds, cash, and gold. Then there's the classic 60-40 portfolio. This is 60% stocks and 40% bonds. Then there's what he calls steady stocks. He defines these as low volatility, meaning low standard deviation, with high dividends and positive momentum. And Then there's the steady 60/40 portfolio. This is a blend between steady stocks and the classic 60/40. It's the 60/40 mix, but swapping in those steady stocks for the stock portion. His findings show that the permanent portfolio had the lowest short-term losses over a 1-year period, but over 10-year periods, the steady 60/40 matched much of that lower downside risk and delivered far higher long-term growth. And that's powerful. It shows that a portfolio tilted toward low volatility income producing equities might be able to smooth that ride without sacrificing meaningful returns. Now, past performance never guarantees the future, but a century of data does tell a story. The investors who manage risks strategically tend to last longer and grow stronger. You don't have to predict the top, you just have to stay balanced enough to survive the next valley while avoiding costly decisions made out of fear or ignorance and capturing the next peak. So take a look at your portfolio. Ask yourself, if the market fell 20% this year, what would you do? Alternatively, if it rose 20%, would you be frustrated about missing out? Would you have a plan to get back in? If there's not a clear plan for either scenario, it might be time to revisit your mix. Because while you can't eliminate risk, you can decide which kinds of risk you're willing to live with. This is all part of the wealth expedition, learning to navigate uncertainty, stay steady, and keep moving toward your long-term goals. If you found this helpful, hit that like button, subscribe, and even join my newsletter for deeper insights each week. An online community platform is launching in just the next few weeks or sooner, in which we can take this wealth journey together. We can share specific strategies for budgeting, investing, and entrepreneurship, and encourage one another along the way. I'll see you on the flip side.